What if I told you there's a listed company in Singapore where its cash pile alone makes up nearly 93% of its market cap, with a PE of only 8 and an EV/EBITDA ratio under 2? That's insanely cheap by almost any standard. But here's the catch. It's not a tech stock. It's not a RE. It's a small cap shipping company quietly generating steady profits year after year. Hi, everyone. Welcome back to Durian Finance, where we break down Singapore stocks in a simple, no-nonsense way. Today, we're looking at Singapore Shipping Corporation Limited, S19SI, a stock most investors overlook. Despite its boring name, this company has strong cash flow, low debt, and healthy profit margins, yet trades at a valuation that screams deep value. In this video, we'll break down the numbers, the risks, and whether this hidden gem deserves a spot on your watch list. Singapore Shipping Corporation Limited SSC is a Singapore-listed shipping group with roots dating back to 1935. Spun off from Stanford Land and listed in 2000, SSC operates across 4 segments. Shipowning owns 5 pure car and truck carriers, PCTCs, with over 32,000 CU capacity, all on long-term charters to blue-chip operators like NYK and Wallenius, ensuring stable recurring revenue. Ship management provides technical management, procurement, crew recruitment, certifications, inspections, and new build consultation through a team of seasoned mariners and engineers. Agency and terminal operations. Over 50 years in port agency at Pasir Panjang and Jurong Port, offering stevedoring, bunkering, docking/repairs, and special cargo handling, with a 50-year partnership with Daiichi Chuikisen Kaisha, DCKK. Logistics offers end-to-end supply chain solutions across sea, air, and land, including warehousing, distribution, and transshipment, with expertise in hazardous and military cargoes. SSC's conservative model of long-term charters shields it from volatile freight markets, generating predictable cash flows, steady dividends, and a strong balance sheet. In 2023, it was recognized in Forbes Asia's Best Under 8 Billion list, underscoring its resilience. Looking at Singapore Shipping Corporation's revenue breakdown, it's clear that ship owning is the backbone of the business, contributing around 70% or about $34 million. This comes from long-term charters of their fleet of pure car and truck carriers to blue-chip operators like NYK and Wallenius. The remaining 30% of revenue is fairly evenly split across ship management, agency and terminal operations, and logistics, each contributing about $5 million. These smaller segments add diversification and complement the group's core shipping business. In terms of regional presence, SSC's operations are anchored in Singapore, which accounts for about $15 million of value as the headquarters for fleet management and logistics. Malaysia represents about $10 million, where SSC has long-standing agency operations across major ports. Japan makes up around $12 million, reflecting SSC's deep charter partnerships with leading Japanese shipping lines like NYK and DCKK. Finally, another $12 million comes from the group's global fleet deployment, as its vessels are engaged in worldwide automotive and cargo trade routes under long-term contracts. Now, let's take a closer look at Singapore Shipping Corporation's financial performance. For the latest trailing 12 months ending March 2025, revenue came in at about $48.5 million, with net income at $11.4 million. That's a significant improvement over 2024, where revenue was $45.5 million and net profit just over $9 million. EBITDA has been steady, around $20 million in 2025, showing healthy cash generation. Operating margins and net profit margins have also improved, hitting over 20% and 23% respectively in the latest year. On the balance sheet side, SSC sits on a very strong cash position, about $80 million, compared to total debt of just under $30 million. This keeps the debt-to-equity ratio low at under 20%. Earnings per share have climbed to around 5.5 Singapore cents, and the board has declared a dividend of 1.4 cents per share, consistent with prior years. Finally, if we look at return on capital employed, it's around 8 to 9%, which shows SSC is making reasonable returns on its assets while staying conservative with leverage. In short, These numbers highlight a company that may not be high growth, but is stable, profitable, cash-rich, and consistently rewarding shareholders. Quick break. If you made it this far, smash that like button. The YouTube algorithm loves likes almost as much as I love durian. And don't forget to subscribe. I spent hours sweating over reports and editing. My laptop fan now sounds like a cargo ship. So hit like, subscribe, and keep this channel sailing. Now, let's move on to valuation metrics. As of mid-2025, Singapore Shipping Corporation has a market cap of about 314 million Singapore dollars, with an enterprise value of 278 million. The stock is trading at a price-to-book ratio of 3.3 to 3.5 times, which is high compared to earlier years when it was below 2 times. On earnings, the trailing P/E ratio has come down to about 9 to 12 times, making the company look cheaper on a profit basis despite the higher book valuation. Returns have improved significantly. ROA is close to 29% and ROE nearly 44%, while ROIC is around 37% and ROI about 48%. These are very strong numbers compared to historical averages. From an enterprise value perspective, EV to EBITDA is now under 5 times, and EV to sales sits at 2.5 times, suggesting the stock is reasonably valued on cash flow metrics. Finally, the net asset value per share has been rising steadily, though the updated 2025 figure is not yet available. Overall, these metrics highlight a company that has shifted from a modestly valued, asset-backed stock to one delivering strong returns on capital, while still trading at a relatively low earnings multiple. Let's break down whether Singapore Shipping Corporation is expensive or cheap at today's price. First, looking at cash per share versus share price. Back in 2021, the stock was trading at 24 cents with only 15 cents of cash per share, meaning just 63% of the price was backed by cash. Fast forward to 2025, the share price is still around 29 cents, but cash per share has almost doubled to 27 cents. That means today, a massive 93% of the share price is literally backed by cash on the balance sheet. Investors are essentially paying very little for the underlying business. Second, if we look at earnings and valuation ratios, net profit has grown from 9 to 10 million in 2021 to 2024 to 11.4 million in 2025, and EPS has ticked up as well. Meanwhile, the P/E ratio fell from about 22 times in 2022 to under 12 times in 2025, and EV to EBITDA also compressed to below 5 times. By these measures, the stock is actually cheaper today than before. The only metric that looks more expensive is the price-to-book ratio, which climbed from under 2 times in 2022 to more than 3 times today. That shows the market is now paying a premium to book value, probably because of the company's strong balance sheet and steady profits. In conclusion, for value investors looking at earnings and cash flow, SSC looks attractive right now. For asset-based investors focusing on book value, the stock may look pricey. Overall, this is a stock where the market price has barely moved, but cash and profits have grown, making it more of a hidden value play than an expensive bet. Now, let's compare Singapore Shipping Corporation with 2 of its closest listed peers, Samudera Shipping Line and Penguin International. On profitability, Singapore Shipping posted about $11 million in net profit, while Samudera stands out with a much larger 118 million Singapore dollars, and Penguin comes in at 35 million Singapore dollars. When we look at balance sheets, Singapore Shipping is very conservative, with a debt-to-equity ratio of only 19% and $80 million in cash. By contrast, Samudera is more leveraged at nearly 47%, while Penguin sits in the middle at around 23%. In terms of efficiency, Penguin leads with a return on capital employed of about 18%, followed by Samudera at 12%, while Singapore Shipping trails at 8 to 9%. Valuation tells an interesting story. On P/E multiples, Samudera is the cheapest at around 4.6 times, Penguin trades at 7.4 times, and Singapore Shipping looks more expensive at 9 to 12 times. But on price to book, Singapore Shipping is richly valued at over 3 times book value, while the other 2 trade closer to book value, between 0.7 and 1.3 times. In short, Singapore Shipping is a defensive cash-rich player, Samudera offers high profit but more leverage, and Penguin delivers balanced returns at a mid-range valuation. Now let's look at the opportunities and risks for Singapore Shipping Corporation. On the opportunity side, the company is sitting on a huge cash pile of about 80 million US dollars, which is almost equal to its entire market value. This gives investors strong downside protection and the potential for steady dividends or even acquisitions. Its long-term charters with blue-chip clients like NYK and Wallenius provide stable recurring income, regardless of short-term shipping cycles. On top of that, the stock looks cheap on a cash and NAV basis, with nearly the whole share price backed by cash. Add in low debt levels and consistent dividends, and SSC positions itself as a defensive play with solid fundamentals. But there are risks. Growth has been limited, with revenue stuck between $45 and $49 million for the past 5 years. The shipping sector itself is cyclical, vulnerable to global trade slowdowns and freight rate volatility. Valuation-wise, SSC is traded at a high price-to-book ratio, which may not hold if profits soften. As a small-cap stock, it also suffers from low liquidity and limited analyst coverage, which can dampen visibility. Finally, returns on capital are relatively modest, and the business is heavily reliant on just 5 PCTCs, meaning concentration risk is real. In short, SSC is a cash-rich, stable, and undervalued company, but it comes with growth and concentration risks investors should carefully weigh. So here's the verdict. Singapore Shipping Corporation is cash-rich, steady, and undervalued, but don't expect explosive growth. It's a defensive play for patient investors. If you found this breakdown useful, smash that like button, subscribe, and drop a comment below. It really helps the channel, and I'd love to hear your thoughts.